Hi, I'm Jim Lineweaver, your financial quarterback since 1993. Over the next few minutes, I will provide a quick overview of the markets, recent performance, key events and issues, and factors of influence, including the war, strategic portfolio positions, and what that means for you and your portfolio. The market is off to a challenging start this year. Through the first 2 months of the year, the S&P 500 was down about 8%. So even with the markets rebounding in the last few weeks, the market still remains down about 5%. And then if we look at bonds as measured by the Ag Bond Index, the bond market is actually down closer to 7%. And this is primarily due to the Federal Reserve increasing rates in March, and they're anticipating another 6 to 7 more increases over the next 12 to 18 months, according to MarketWatch. So the equity market performance through the first 2 months is the fourth worst performance on record, dating back all the way to 1926. But a poor start doesn't mean really a poor year. So in fact, in 8 out of the 10 other worst starts, the market was up in the remaining 10 months and on the average of 26%, which included 2 down periods. The volatility of the stock market has picked up with the development around COVID, geopolitical matters including the war, and expected moves in interest rates, which can impact the value of stocks and bonds. So this chart shows the number of days the market was up or down more than 2%. Through February, there were 4 days with a plus or minus 2% swing, and there were another 7 days that were closer to a 2% move. In all over the last year, there were only 7 of these total, so volatility has definitely picked up. In our experience, sometimes individual investors tend to make emotional and often irrational decisions during periods of financial market volatility. But it's important not to panic. The conflict between Russia and Ukraine has taken center stage and is in the headline news every day. The human toll is devastating, which is far more concerning than anything stock market related. The following chart shows historical stock market performance amid geopolitical turmoil. Each crisis at the time likely felt uniquely challenging. And the current situation between Russia and Ukraine may be the most significant military conflict since the end of the Cold War. But experience shows that investors do well to see through the volatility and stay invested. In 8 of the last 10 major conflicts, the stock market was higher by an average of 12% a year after the event, and the average annual return over the following 3 years was over 10%. And what's more is only one instance was it actually negative. Other factors such as expected increases in interest rates, inflation, and oil shocks are also adding to the market volatility. But it's important to stay the course. Individual investor sentiment has declined to very pessimistic levels, reaching levels similar to those at the outbreak of the pandemic in March of 2020. Yet we know that the world fought through the pandemic and financial markets recovered. And even today, with the sell-off, the S&P 500 is 80% above the pandemic lows of March 2020. And while a diversified portfolio doesn't always feel good, over the long run, history proves that they work. This chart shows how a diversified portfolio performed versus the S&P 500 over the last 20 years. In 2000 to 2002, also in 2008 and 2020, this portfolio example showed a diversified holdings being down only 16%, 27%, and 23% respectively. This undoubtedly was painful, but during these periods, the stock market was actually down 40%, 37%, and 30% respectively. So the most interesting thing is that by the end of the period, the total return of the diversified portfolio was very comparable to the stock market alone, yet without anywhere near as much volatility or pain for investors. It may not have felt good in the down periods, but the investors who stayed the course were rewarded. We have taken action in several model portfolios over the past several months. For example, late last year, we adjusted portfolios, locking in some profits. We remained overweight in the U.S. and reduced our exposure to emerging markets, which turned out to be pretty good given that emerging markets have exposure to Russia and the Ukraine conflict. At the end of February and the beginning of March, when the S&P 500 was down approximately 15% off its highs and the NASDAQ was down in correction territory around 20%, we found our equity weightings were below their target range. Therefore, we reallocated portfolios by reducing some international exposure and adding to the U.S. equities to take advantage of the pullback. This helped reduce our weightings in Europe, as the region is likely to experience economic slowdown while the U.S. remains in a relatively better position. Since our reallocation, the S&P 500 has come off its lows and recovered about half of its losses. We positioned the portfolio for higher inflation and rising interest rates in fixed income. So the fixed income will continue to be challenging over the next 12 to 18 months. The Federal Reserve has started to tighten their monetary policy and began raising interest rates in March by 25 basis points or 1/4%. I hope this overview of the markets helps you understand some of the critical developments in the current environment. However, this is a high-level picture, and the way it applies to individual portfolios and accounts may vary. So as the markets adjust to these changing conditions, we will closely monitor the situation and make changes based on your financial needs, goals, and risk tolerance as necessary. While we do expect continued volatility in the near term, we are cautiously optimistic. So as always, we invite you to call or email us if you have any questions regarding your individual portfolios.